how to write a B plan. So today is the second workshop, and also I would like to remind you all that we have the registrations open till 14th of January. So I request you all to kindly register as soon as possible. So without wasting much time, I would request Vikrant sir to take the session.
Thank you, Anisha. And guys, welcome all to our second session on how do we go about creating business plans and financial model. Just to summarize what we did yesterday, yesterday we understood how do we go about creating a business plan. Now the business plan had sections, and what sections were those? Predominantly, there were three sections. One section was around what is the company currently doing? What is the business? What is the customer base? How much traction have they received? Who are the founders, etc. So explaining what the business is. The second section was explaining what the future plans of the business are. So am I going to launch new products? Am I going to expand to newer geographies? Am I going to actually work on I would say hiring more people, etc. Right? So how do I take my product to larger set of people, to larger set of customer base, through what channels? And are there any new products or services which I'm going to launch? And any other growth area that you are essentially targeting? That's the second section which we saw. So the first section was around the current, what the business is. Second section was around where the business is going to be, how the business is going to grow in the future. And the third section is what we are going to discuss today. And that section is all of the future plans that we have mentioned that we will do. How does that translate into financials? How does that translate into revenues? How does that translate into profitability? So as a part of the business plan, these three sections are always there. It is mandatory. And today we are going to focus only on how do we go about making financial projections for a business, which you should include in a business plan. Now let's understand what is it that we are looking for in financial projections. So we are looking for following things. How much revenue will you make in the future? What will be your costs? What will be your cost structure overall? And how much funding will you require for actually taking your business to the next level? So whatever business plan, whatever projections, whatever plans that you have mentioned in your first two, in the second section, how much money will be required to actually take your business to the next level is what we are going to figure out. So this is what financial projections essentially entail. What would be the revenue? What would be the cost structure? How much funding will be required from a future perspective, right? So before we deep dive into making projections, first let's understand some basics of finance. So I'm sure you would be aware of it, in terms of what finance is, and you might have kind of studied it from the accounting perspective, etc., in various courses that you would have taken or through your reading. But I'm going to just give you a very back of the envelope perspective of finance that any person can understand. Anyone will be able to understand this. So what is what do we need to project? What are the three things that we need to project? And the first thing is the P&L. So we have to make a projection of the P&L. But let's first understand, how does the P&L look like? What is exactly a P&L from a very layman perspective, right? So let's say it all starts with revenue. How much money are you going to make? So if I am selling possibly a bottle of water, right, mineral water, then one bottle of water costs say 20 rupees, and I'm going to sell 1,000 such bottles. And therefore, my revenue is going to be 20,000 rupees. How? The per unit price into the total number of units that I'm planning to sell, that makes it the revenue. That is how revenue gets calculated. So how does the revenue gets calculated? What are the number of units that you are planning to sell? That multiplied by your selling price gives you the revenue. The next line item is what we call as COGS, or cost of goods sold. So if I am selling a bottle which is for 20 rupees, what is the cost of manufacturing that bottle? You know, so what will it require? It will require the water inside, it will require the cap, it will require the bottle, the label, you know, it will happen in a particular manufacturing unit, etc. So per bottle, on a per bottle basis, what is my cost? So for example, on a per bottle basis, if my cost is 5 rupees, and if I am planning to sell 1,000 bottles, then my cogs is actually 5,000 rupees. You can say the cost of producing this sales, the cost of producing the, or the cost of servicing these 1,000 bottles which I am planning to sell is coming out to 5,000 rupees. So now how will my PNL look like? My PNL will look like the revenue, which is 20,000, minus cost of goods sold, which is 5,000. So the net revenue, or what we call as the gross margin, the gross level margin that we have, is somewhere around 15,000 rupees. How? 20,000 minus 5,000. Excuse me. That will come out to around 15,000 rupees. So now what is it that we have revenue, we have cost of goods sold, and we have net revenue. uh, After the net revenue, you have various operational costs, like you will have people that you will have on your roles. You know, you will have a manager, you will have possibly someone who would look at distribution, your own cost, etc. So that is the manpower cost, right? Cost of people. Then you would have some marketing costs, that is cost of marketing this particular product or service. And then you will have certain general admin costs, such as rent, electricity, etc., right? So there is operational cost. At operational cost level, we have three types of costs: there is manpower, marketing, and general admin, main three types of costs. Now once you subtract the total of these operational costs from the net revenue, from the 15,000 rupees, you get something called as operating profit, or what we also term as earnings before interest, tax, depreciation, and amortization. It is called EBITDA, EBITDA. It's in the finance language, it's called EBITDA. EBITDA is basically your operating profit. What is the amount of money that you are making on an operating level once you subtract all the costs, whether variable, whether fixed, from the revenue, and now you get something called as EBITDA. Now, after EBITDA, there are basically three more cost items. And what are these cost items? There is depreciation and amortization. If you have taken loan, then there is interest, and then there is tax. So from the operating profit, when you reduce depreciation of assets and you reduce the interest that you are paying to the bank, what you get is a profit before tax, or what we also term as PBT. On the PBT, you apply a tax rate, and what you get ultimately is profit after tax, or PAT, right? And profit after tax is actually your profit, is net profit as we call it, right? So you take any business, this is how structurally, in a very simple way, a PNL looks like. Now what are you going to do in your projections, in your financials? What are you going to do? You have to project this PNL. You have to say that this is how it is going to look in the year after, 1 year later, or a year after that. That is what we are talking about, projections. So what is projections? Projections is nothing but this PNL you are forecasting. You are saying that, okay, next year how will this look like? The year after that, how will this look like? Typically 2 to 3 years of projections is what you can, attempt, or you can try. Now how do you go about doing that? You have to make certain assumptions, and those assumptions form the basis of projection. So let's discuss first the assumptions that lead to projections. It is extremely important to understand that. Now let's say I have a question to all of you, and you guys can either write on the chat window, or unmute and speak about this. Suppose you are preparing a business plan for a restaurant business, right? Now the restaurant business is going to open. In the business plan, you are saying that 1 year I have one restaurant, and 1 year later I'm going to, or after, the plan is that in the next few months I'm going to open one more restaurant, right? So how will you project this PNL for restaurant business? What all things would you consider in mind? If I have to project the revenue, if I have to project the profit and loss statement of a restaurant business, how will I go about doing it? What will I do? Any thoughts, guys? What is it that I will do to actually project the PNL of a restaurant business? All of us know restaurants. How will you project the restaurant business revenue? Okay, there are certain answers, responses coming on the chat window. Uh, Expected footfall in the venue might help. Very, very good answer, right? Neela is saying digital marketing. Yes, that's a cost element. That basis digital marketing, you will essentially, get certain people. But what more? What more? Go on. What all will you consider when you have to consider revenue and costs of a restaurant business? What all things will you have to consider? What are the various aspects that you will have to project? Any thoughts? Raw material cost, yes, very important, that you are actually selling number of orders and price of each product. Yash is saying very important. Targeting a particular class of society, place, area for store, perfect the place, the cost of the real estate, right? And you guys are absolutely right. This is how it will work. So what we will have to do for projecting this is, first thing is we will have to take care of certain footfalls, which means what? The first assumption is going to be that in my restaurant on a daily basis, 100 people will come in, and 100 people will on an average buy food worth at least 150 rupees. Now, this is the footfall, and the average ticket size or the average order is what I'm going to consider to get the revenue. That, okay, on a daily basis, I'm going to get, say, 100 people, and these 100 people actually will help me in actually, ordering like for 150 rupees. So my everyday revenue is going to be 150 into 100, and that is coming out to this much. So my monthly revenue is expected to be this much. Possibly on the weekends I'll expect more footfall, so I'll take more footfalls on the weekend and less footfalls on the weekdays. But the question that I have for you is, how will I even make the assumption of footfalls and the average ticket size? What do I do to kind of make an assumption on footfall and average ticket size? How do I ensure that that particular thing is taken care of? How do I ensure that that assumption is right of the average footfall and the average ticket size? uh, Market analysis, one, you are right, that what you will do is you will look in the market, you will see that, okay, in a particular restaurant which is, say, in the same area, typically these many number of people go in, and typically this much is what they kind of order, right? The value. Or the other way around is, you already have one restaurant, right? The guy already has one restaurant, so you can use the data of that one restaurant, existing restaurants, to make certain assumptions. So always remember, historical analysis Hi, can you hear me, guys?
Yes, sir.
Yeah. So what I'm saying is, those numbers, those details have to be validated, guys. And therefore, that validation of assumptions is very important. The validation of your assumptions, in our case, footfall, average ticket size, will either come from your own past experience, or it will come from market analysis. However, the past experience and the market analysis both have to be adjusted for a particular situation. What do I mean by that? My current restaurant is actually located in a lane which is slightly inside, and therefore there I am getting on a daily basis 50 footfalls. But my new restaurant is located right on the main street. So one thing I know for sure, that I will definitely be able to make more than 50 footfalls. Possibly I'll be able to make more than 150 rupees. But whether more than 50 means 100 or 150, I will get to know with market analysis. How? Now in the new location around that, I will do some market analysis and figure out that, okay, this guy who has been established in this location for a long time does not get more than 150 footfalls on a daily basis. So what you will do, you will make your assumption as somewhere between 100 to 150, saying that, oh, in my old location, where which was less, which was inside, these many number of people are coming, but I cannot expect 200 people, because there is a large restaurant which is already operating for the 15 years in the past, and they are getting this much, so I will be somewhere in between. So always remember, whenever you are projecting, your assumptions need to be validated using historical data or using market data. But like I mentioned, these assumptions and the historical data which you've gotten from historical data and market data have to be, or need to be, adjusted for a particular situation, right? So this is how we will calculate the revenue for the restaurant. How will you calculate the costs? Now, what all do we have? A restaurant will have rent, chefs, waiters, raw material. These will be the very important costs. So you know that in a particular area, a 200 square feet restaurant would cost, say, 30,000 rupees 30,000 rupees, right? So now consider rent as 30,000 rupees. On an average, chef costs around 20,000 rupees and a waiter costs around 15,000 rupees. Example, build it in the wall that, okay, I will need four chefs, two for the afternoon shift, two for the evening shift. I will need eight waiters, four for the afternoon shift, four for the evening shift. So four chefs into the cost of chef plus waiters into the cost of waiters will give me the cost of, I would say, people which are required, right? Then comes rent, we have already considered. Then comes the raw material. Now raw material can be anyhow, you will have to figure out. It can be either percentage of a particular dish. So for example, in restaurants, typically, a dish which is which costs around 100 rupees, the cost of material there is somewhere between 10 to 15 rupees or less than that, right? So apply a percentage, again basis the historical data. You are already running a restaurant, therefore you would already know that at what cost the food would come in, the raw material would come in. So that is one way, raw material as a percentage of revenue. So now what you have actually done is, you've actually built a PNL or a projection for a particular restaurant business, and you have done it very intelligently with real data, with market data. You've also built it intelligently with your existing, I would say, your experience, and also by doing a market research. So now the way it looks like is, again going back to our PNL, the way it looks like is, you have the revenue, which is footfalls multiplied by the average ticket size. Then you have the cost of goods sold, which is actually your the cost of the food items, right? The individual, the cost to you, right? Raw material cost. After that, you will have net revenue. Now net revenue may say you will subtract operational cost. The manpower cost for a restaurant will be chef, stewards, and waiters, right? There will be certain marketing costs, and then there will be general admin costs like rent, electricity, etc. What you will get is an operating profit or EBITDA. And this is effectively the way you would project a particular year for a restaurant business. Now, As you add more and more restaurants in future at various geographies, you can do this multiplication on one unit of restaurant and get a consolidated P&L made. For example, now that you have done it for one, you can do it for five more in the next year. You can say that today, okay, next year I'm going to open five restaurants. The year after that, I'm going to open 15 more restaurants. So for five restaurants, depending on the location, depending on the size, you can actually, create their costs and create their revenue projections. For the remaining, the next year 15, you can again go the same. Ultimately, your final P&L will have a sum of all these individual restaurant P&Ls that you've built. So you get the company profit and loss statement, and you've actually projected the restaurant business, right? So in your current exercise which you are going to do, the business plan that you are going to prepare, step one is going to be study the company, understand the business, because only when you will understand the business, you will be able to understand the costs, you will be able to understand how do they make revenue, you will be able to understand the assumptions behind projections. How will you make those assumptions? You will make those assumptions by asking these companies details about their past data, and by doing competition market analysis, that what is happening in the market. Basis that, you will create your own set of assumptions, and those assumptions will be utilized for actually creating your projections. Are there any questions? Are there any thoughts till now? You have any questions till now? I'm going to pause quickly for a minute to see if you have any questions. Anyone? Have you guys understood it? How, in a very simple way, I've tried to kind of explain that how to actually make your projections. What is the way that you can, what is the thing that you can keep in mind for making these projections for the business plans that you are trying to make. Okay, great. So I'm assuming there are no further, questions. Now, guys, while we have only discussed profit and loss statement, you guys must be aware that there are two more statements that are required. One is the balance sheet, and the other is the cash flow statement. So my humble request to you is that in your current business plan, which you are going to make, even if you make projected profit and loss statement, that is enough. Even if you are able to make that at this stage, it will be a very big achievement, I would say, right? And beyond this 1 hour, you yourself will have to do a lot of research around, understanding the business, how to build it, how to make projections more, etc., right? But when we do it in real life, when we actually do it for companies, and when we actually do it for companies who are looking to raise money from investors, we actually project two more statements. One is the balance sheet, and other is the cash flow statement. So from an understanding perspective, let's look at these two statements as well, right? And how do we kind of project them as well? So the balance sheet typically, has two sides, right? One is basically the asset side, the other is the liability sides, and always, and then there is third, which is the equity, right? So always total liability plus equity is equal to total assets, right? So the total liability plus equity is the money that is deployed in the business, and whatever is the amount of money that is deployed in the business, you will have on the other side assets against that, right? So assets and liabilities both are categorized as long term and short term. So long term assets and long term liabilities are very easy to understand. For example, any kind of plant, machinery, equipment, land, building, etc., is a long term asset, right? What do you mean by long term? That tomorrow you have land or you have building, you're not going to liquidate it in one day and you will make money. No, it's a capital asset, right? It's a long term asset. So plant, equipment, machinery, land, building, all of these are actually long-term assets. And what are long-term liabilities? A loan from a bank which is taken for 5 years, 10 years, etc., is an example of a long-term liability, that you have taken money from someone, and that money is taken from someone for a long period of time, for upwards of say 5 7 years. That is what is called as the long term liability. So these two are very simple to understand. Now, slightly tricky to understand are the short term assets and the short term liabilities. So what are short term assets? There are three major types of short term assets, guys. One is whatever cash is available in your bank account, that is definitely a short term asset. You can actually quickly use that cash to buy something. You can quickly use that cash to pay off salaries, etc. Right? So typically, the short term assets include cash. It also includes inventories. So you have created bottles of water. You are in the business of selling bottled water. You've created bottles of water, and those water bottles are in your store waiting to be shipped to the stores, and you can make money out of that, right? So these are essentially short term assets. Again, the inventory is a short term asset. The third one, which is the short term asset, is the account receivable, which means the money which you are to get from the customers. So you have delivered a product or service to the customer, but the customer has not yet paid you. The customer is yet to actually pay you. So he is expected to pay you at any point in time, and that is therefore an asset that you have. That someone who is, your money. Actually, you are going to get money from someone, and that essentially is, you can say, is basically a asset, and it's a short term asset. Whereas on the other side, what is a short term liability? Uh, a short term liability is basically a money that accounts payable, right? Money that you are yet to pay. You are liable to pay someone, you've not paid that someone, and that is what your short term liability actually is. And finally, there is equity, right? Whatever money you have put in, or whatever money investors have put in, ours is sitting in the equity section of uh, uh, the balance sheet. So always remember, total assets is always going to be equal to your liabilities and equity put together. So liabilities and equity is the money that you deploy for the business, and assets is what you create in the business. So always the money which is deployed in the business, which is liabilities and equity, is equal to your assets on the balance sheet. So this is a very simple format to kind of understand the balance sheet, right? Uh, in your projections, actually, you also have to project your balance sheet, right? And you actually make assumptions on each of these, and you actually project your balance sheet. For example, you know that, okay, how much money you want to you need to build land or equipment. Now that money gets into your long term asset. You know how much loan you will require to actually get a factory in place. That becomes your long term liability. Every business has a working capital cycle, guys. What do we mean by working capital cycle? From the time you deliver, from the time you start producing to the goods, till the time you get money from the client, there is a capital cycle. There is money locked in the system. Now that is called working capital, right? Now, the way it happens in manufacturing is, for example, you buy a manufacturing unit, buys raw material, prepares finished products, ships those finished products to customers, and after shipping those finished products to customers, after say 60 days or 30 days, the customer pays you. So the process of, so from the time you've kind of put in money to kind of purchase the raw material, till the 60th day on which you are going to get the money, the capital is blocked from the entrepreneur's side. that capital is actually something which you have to consider, and that is what we call as working capital. It is very important to understand working capital, guys. Many people understand P&L, many people understand balance sheet, but working capital is something which is very, very important to understand. From a formula basis, you might read in the books that, oh, working capital is current assets minus current liabilities, etc. But don't study it from that perspective, from a formula perspective. Understand what working capital is. The amount of money that I need to, as a business, put in to ensure that revenue comes into picture. So where will I have to put money to ensure revenue comes into picture? I'll have to buy raw materials. I'll have to kind of make, these bottles. I'll have to pay salaries. And then after delivering the goods, after 60 days, I am going to get essentially my money. So there are a good 120 days in between that the expenses have to be funded. And this funding has to come from somewhere. Now, these 120, the funding required for these 120 days so that you can make a particular amount of revenue is called as your working capital, right? So banks also give you loans to kind of fund your working capital. Startups raise equity to kind of fund some of their working capital requirements, etc. But try and understand a real life business scenario of a particular working capital. There are certain businesses which work the other way around. They are always cash rich. For example, you are actually taking a membership to the gym. Now you pay the money to the gym for the entire year in advance. You don't say that after completion of 1 year, after 60 days, I will give you, money. No, the membership is paid upfront, even before you start consuming the service, even before you start your first workout in the gym, right? So such businesses work on different way, whereas the manufacturing businesses work on different way. The typical manufacturing businesses where money has to be deployed in working capital are called as positive working capital businesses, whereas the businesses where you don't have to deploy working capital, but you are getting payments in advance which you can use quite often, is called as actually is called a negative working capital business. It works the other way around. So the good business is called a negative working capital business, or business which has enough cash which takes advance payments is called negative working capital business, whereas something where money gets locked on a day-to-day basis is called as a positive working capital business. And this is how essentially your balance sheet gives us understanding of working capital, right? Finally, there is something called as cash flow statement. And guys, let me tell you, if you have to identify, if you want to actually do analysis on a business, the first thing that you should get hold of is cash flow and not PNL. PNL's profit and loss statements are deceptive, whereas cash flows are actually the reality. Why cash flow is a reality? Why PNLs are deceptive? Because PNLs have an item called depreciation and amortization, which is a non-cash item. What do I mean by a non-cash item? In depreciation and amortization, no money is going out as expense. You've already made that expense, and you are just actually what you are doing is you are just dividing that expense into number of years, and that is what you do using depreciation and amortization. So a typical cash flow statement would start with operating profit, because after operating profit you have reduced the depreciation and amortization, which is a non-cash item. So from the EBITDA, from the operating profit, you subtract the interest, you subtract the tax, you subtract the money required for working capital, and you subtract capital expenditure, which is you would have bought a plant, a machinery, factory, etc. That is what you get as net cash burn. And seeing whether this is positive or negative is very critical. To this net cash burn, you add equity or debt which you have actually raised in this particular year or in this period. And that becomes your net cash, right? So whatever EBITDA may say, whatever expenses, interest, tax, change in working capital, capex you have done, you get to know what is the net cash. And from the net cash, when you add equity or loan which you have borrowed or which you have raised from investors, cash burn, you get net cash. To that, you add whatever is the opening cash, whatever cash is already there into the system, and now you get to know what is the closing cash. So it is very important to understand the cash situation of the business rather than just understanding the situation on the P&L side, guys. Only instead of understanding profit and loss statement, it is very, very critical to understand what is the position on the cash flow statement, guys. So typically P&L, balance sheet, and cash flow, these are the three statements that we project. We make certain assumptions, we make certain we kind of study the past historicals, study the market, get to certain set of assumptions, and make projections. The reason why I wanted to explain balance sheet and cash flow also is that if and when you happen to enter the real world of finance, and especially finance, you will then be projecting balance sheet and cash flows as well. For the sake of simplicity of this exercise of the business plan which we are going to make, uh, even if you are able to systematically project P&L for the next 2 to 3 years and have assumptions which are validated and are able to properly explain it in a realistic way, it is very important. What do I mean by realistic way? Today a startup is doing 2 lakh rupees of revenue, and suddenly next year you have projected to be 100 crore rupees of revenue. Now, is that realistically possible? Try and understand. Has there any company in the world who has before done that, that today they are 2 lakh rupees of annual revenue and tomorrow they are doing 100 crore rupees of revenue? So make those assumptions very, very realistic, right? It cannot be wacky. It cannot be like completely bizarre where suddenly the company is becoming 5,000 crore revenue company and 1,000 crore profit company in the next 3 years, right? It takes time. So what are the assumptions? What are the numbers behind your assumptions? What are the reasons for those assumptions become very, very critical from an understanding perspective. Any thoughts that you have, anything that you have in terms of questions, anything that you want to ask as doubts, please feel free to ask questions. Anyone? So what I'm going to do is I'm going to take a quick 2-minute pause, a break, for you to actually think of questions that are coming to your mind. And post 2 minutes, we will start with the question and answer session. So I'll see you in around 2 minutes. Okay, so I think I had kept aside the last 15 minutes for question and answer. Uh, so from content perspective,